Markets have been volatile since the launch of U.S. trade tariffs. But what should investors be focused on if they want to navigate the current uncertainty? Joining us now to discuss is Brad Simpson, Chief Wealth Strategist with TD Wealth. And Brad, thanks for joining us. And what are some pretty interesting times for investors?
I would say this is about as interesting as it gets, for sure. It's great to be here.
One of the things that you highlight is how our brains actually process feelings like fear. Walk us through that.
Yeah, and I think it really is a terrific way to kick this off, is to go, I think, through this day and a half of markets, what it looks like, and start out with as you're an investor, and the operative word is investor, because on the tail of those of what I'm showing here is the kind of this margin call and short covering, is the other thing which we've talked a lot about, is that markets in the short term today, like unlike any other age and era that's ever existed, very much trade on algorithms now in the short term. And algorithms and investment are two totally different things, right? I'm investing something for its future cash flows, and I'm going to hold on to it for a long time. Algo trading is like being at a casino. I'm not here to knock that. I'm just saying I'm in business number two, not the speculative side of this one. But these algorithms also create really strange whipsaws inside of markets. Now the problem is, if you're an investor, we are hardwired, and the why we're all alive on this planet still is that in our primitive days, we were hardwired to go, wait a minute, there's a rustling in the forest there. That might be a lion. Run.
I'm going to go the other way.
Yeah, right? And this amygdala hijacks your system still, because we lived in an environment like that a lot longer than we have in our kind of cushy urban lives and our modern lives that we live in today. And so right up front is that I want to point out with this is that making decisions based on your amygdala is not a good idea. And so if you take our primitive brain and you combine that in a market with an algorithmic marketplace, those two are not a tonic that work really well. So I just, to investors up front, is to say that know that amygdala right now, and when you're seeing those, is going to really play on you. And we also live in a world where there's a lot more playing on you than it ever has before.
One of the things that you point out in your report is that where people get their news from can fan the flames of anxiety.
Yeah, no, we do. And so but we brought, of course, I brought another chart along to look at this, but the next part is that we're in a volatile environment with another thing that we've actually, as investors, I'd argue, with high volatility, haven't had to deal with at this point. And that is, I've got here where Americans get their news: television, radio, print, digital devices. And of course, what we're seeing in the digital devices is that, if you're 18 to 29, like you're not sitting at home with your mom and dad watching CNBC, right? You're looking at your market news, and you're scrolling on your phone. Well, the fact of the matter is that your 18 to 20 or 9-year-old, those have a tight relationship with their grandparents, and they've taught them how to use the digital device and get their news from there too. Now, the reason I'm bringing this up is that the way algorithms work in equity markets, they kind of work in social media, because it's the social media folks many of whom left their jobs at social media companies and went to trading companies. And what happens is that I go, there's a market correction. There's something about tariffs in the news. There's some bad news. I do a search on that. And that search, of course, brings a feedback loop that brings me worse and worse and worse information. And so people aren't getting kind of sober, factual news anymore. They're not opening up, your dense Financial Post from 25 years ago. It's a 20-second clip on an Instagram that has some facts about the market, what's going on. I mean, we had the market move yesterday, an extreme move on a misunderstanding between the Bloomberg name. I mean, that's about all you need to know. And I think that to hit this home is to take both of these together and say, if I'm an investor, I've really got to be cognizant of this, because all of us, I'd argue in society, have never had to be able to think in an environment that is this extreme, that we have information being sent to us and we're consuming it in a way that we've actually in our existence have never done before. It's pretty extraordinary. And I think by pointing that out is that so much, like we've always known that behavior is an important element of succeeding as an investor. It's never been as more important than it is today. And it goes well beyond behavioral economics, which is really important. It's actually also understanding that we've got this amygdala, but this cerebral cortex that we have needs to be able to sort out the noise and say that between the algorithms in the way markets move today and the algorithms in the news that we're getting, boy, we got to somewhat be able to tune those things out and go, how am I going to look at things? And I'm going to make decisions based on sound process decision making, not with a lot of noise.
And when you talk about noise, let's put the current drawdown into context. You say that markets have a pretty good history of bouncing back from sell-offs.
Yeah, there's a couple pieces, and I brought another chart here, but here's a point I really want us to think about and hammer home here. And again, it goes back to the environment that we live in. So I went back to 2000, and I thought that was a good time because, boy, we've had some spectacular, difficult days since 2000. And so, of course, we're showing here the tech bubble, and what we're doing is looking at the declines of the S&P 500 and TSX, like down 47%, down 23, and look at the S&P 500 TSX during the Great Financial Crisis, 57%, 47 for the TSX, and then the pandemic, S&P down 34, TSX down 37. Look over then at 18%, which, we peaked out about 20 for the S&P. Let's call it 9 for the TSX. I'll get back to the orange bars in a minute. Those are balanced portfolios. Now, I shudder to think if we had algorithmic trading and people get their news source in 2000 or during the Great Financial Crisis where markets would have been. Look at the difference in losses there. 18%, 9% where we are year to date for the TSX and the S&P 500, 47% back on the tech bubble. You would think, listening, reading where we are, that we are in a world of calamity right now when these markets drop. They're not. They're not even on a relative basis. And I think the point I really want to hit home here is the starting point of this is that we had written and published a piece coming into this. We thought the market was like guaranteed, you're going to see a 10% market correction this year. We've had that. Okay, so you add another 700 basis points onto that. This is a expected difficult market, but certainly nothing like that. I think that's the first point. Second point is you have a balanced portfolio. It cuts your losses down in a massive way. The next chart we have here is the one that goes, okay, and then the next one of this, it goes, okay, here's the market rallying 2 years after you hit that bottom. The tech bubble, Great Financial Crisis, all those things. The orange ones are your balanced portfolio that are bouncing less, but of course you have way less downside to them. I don't know if we can go back one to look at the downside quickly, having a balanced portfolio. There, so right, so so year to date, if you had a balanced portfolio, and what we're using here for the record is, so we have benchmark portfolios that we have before we go active management or long, short, or hedging and anything. They're just long only benchmarks. This is our balanced growth benchmark, and so you look at tech bubble down 23, down 26 for financial crisis, pandemic down 20. Look, average down 23. Year to date, we're down 7% in a balanced mandate. I mean, that calculates as a bad week in a really difficult market. Again, for context and the importance of being diversified. The next part is I'm saying is how important it is to have a long-term time horizon. I mean, there it is. I mean, we've all heard of have long-term investors have all heard it. There's just the cold hard facts with it. Is that as we work our way through this, you get the painful part, and then the market rallies after that. And I think if you're going to go through that kind of like as a checklist, that really starts to hit home.
Yeah, that's great perspective, especially after what we've been through the last couple of days. Now, we've seen parts of the market fall into bear market territory, and your report shows that bear markets can have different attributes. What are you seeing with this one?
Yeah, so we make this argument that there's three different types of bear markets. So one caused by an economic imbalances, the other one's caused by rising interest rates and slowing growth. Those are the two ugly ones. The third one's an event-driven bear market, and it's caused by a shock to the system, right? So COVID, that was a shock to the system. We saw the numbers that we had there, and of course here we going in. If you remember, a few months I was here and I said, look, let's use as a baseline 10% tariffs globally, right? Let's look at a worst case, 20% globally, which would be heavy. Liberation Day, I came out with, okay, in the worst case, let's say, and people were saying I was being too bearish with my, right? You saw something well beyond that. That caused a shock in the system, and this has been an event-driven drawdown, what we've seen. Now, why this is important is the chart I brought along here. And what chart that we're showing here is saying, okay, when you look at your average decline, event-driven, your average decline is 30%. Now, we saw about 20 so far. So for an investor, you can go your gauge, especially for a long equity investor who's more risk-oriented, you know what your downside potential is in an environment like this one. But here's the real one I think is more important for all of us, and it's the next two. Average duration in months of how long is an event-driven bear market. Like by a landslide, it's your shortest one. It's 8 months. And average time to recovery, so what that means is, right, so remember when you lose your money, and then at times you can actually have the duration over, but it takes longer to make your money back, and with just when you lose and to make that money up, the math on it. So an event-driven time to get yourself actually back to square again is 13 months. Versus a structural one, which is 111 months, which is I think we would have both agree I would take a year and a month over a decade, and so I think if you kind of piece all those together, on the element of a market decline in a bear market with what's going on in the world, so far, painful, but boy, it could be a lot worse. If you're balanced and you have a diversified portfolio, you're pretty well set up for it. If the type of bear market that you're in the middle in is an event-driven one, which it is, bear market tends to work to be in place much longer than the other two alternatives. And I think framing all that out, I think that gives you a far more sober, feet on the ground view of where we are today.